Hey, Steve Saretsky here. Welcome back to the show. Back in the saddle here after taking a 1 week hiatus, which rarely happens. Just on a family vacation there in Hawaii. But lots transpires since we last chatted. In fact, a lot of core themes are now playing out in front of our very own eyes. So I'm going to walk you through that. First and foremost, we had Canada's CPI inflation coming out. Really, some concerns. We went from 1.6% headline inflation back up to 2%. Everybody's starting to freak out, but I think that's a lot of noise. I think it's a lot of noise. You think if you unpack the numbers further and you say, okay, well, we went from 1.6 to 2, of course you're going to, of course you can have some volatility in that. In fact, the Bank of Canada's already acknowledged that. But if you look at the growth in CPI, mortgage interest costs were up 16.7%, and that was resulting in 30%. So 30% of the total CPI growth was just that mortgage interest component. Of course, we know that mortgage interest rates are still coming down. Home rental prices up 8.2%. You guys know what I've been talking about in major core markets like Vancouver, where I'm located, and in Toronto, the two core markets, you're seeing rents declining. In fact, some of the larger property managers that I chat with quite frequently in the city are showing me that rents are down in some cases up to 10%. We're starting to see incentives, first month free rent, throw in your utilities. So it's happening. There's a softness and a weakness in the rental market. This is despite, the Bank of Canada and all the big economists telling us that we're not in a recession. Again, I would beg to differ. Which really leads me into the next point, because there is certainly a recession in the real estate space, and in particular in the home building space. You guys know that I've been talking about this for some time, which is housing starts are going to fall off a cliff. Everybody kind of gets so enamored. You get Krista Freeland going out there and tweeting and saying, hey, housing starts are up on the month, and, when we seasonally adjust it and we analyze it, we're doing all right. The reality on the ground is a housing start takes sometimes 2, 3, 4, 5 years of process and planning to get to a housing start, right? You buy a site, you raise capital for it, you then basically go through a rezoning, the design process, and eventually you get the project approved. Then you got to go and pre-sell it. And then once you hit your pre-sales, then you get your bank financing to put the shovel in the ground. So this many, many, many years to play out. So you actually have to watch real-time indicators to figure out where is home building going. And so we can look at home building that doesn't require massive rezoning and pre-sales. As you look at single-family building, and single-family housing starts have been falling off a cliff. They're at 60-year lows in Toronto. They're at 20-plus year lows in Vancouver. You can also look at pre-sales. So pre-sales in the new home building space. Toronto, I think, are at 27-year lows. Vancouver, you're at 10-year lows in pre-construction sales. That leads, if you can't hit pre-construction sales, you're done. You ain't launching a project, quite simply. And we're starting to see, again, more and more developer insolvencies as the inability to launch projects, as the inability to push through higher prices. Not only that, we know that interest rates went up 500 basis points in the span of a short 18-month period, and the bodies are now rising to the surface. Remember, insolvencies take time. Insolvencies take time to play out. Not only can people hang on for as long as they possibly try to, but it takes time to go through the core process. So we had a large developer insolvency this week that made headlines. Thin development. They've been around for quite a while. I mean, from a reputation perspective in Vancouver, they're a well-known developer. I mean, I would not consider them a tier 1 developer, but they were a large name building concrete towers throughout the Lower Mainland, now entering receivership. Kingset Capital was the lender on a lot of these projects, has now pushed them through into that receivership file. So this was making all the headlines. I believe I was the first to drop it there on Twitter. So that made all the headlines go. And then so we now look and say, okay, well, what is the collateral damage here? So you have the, first and foremost, that story breaks. And then we know that Kingset, which was the lender on that, the following day, they closed the gates on their Canadian fund, their Canadian private equity fund, which basically deploys capital into real estate loans and projects, etc., gated their funds. What does that mean? They close the door. So if you're an investor, let's say, hey, you know what, I got $500,000 here. I want to invest it with, this KingSett Capital Fund. That fund will pay you distributions. And, typically in a normal market, you say, hey, you know what? Maybe I want $250,000 out because I'm going to go buy a bigger home. What happens is when they gate the fund, when they gate it, it means the gates are closed, the doors are locked, and you can't get out until they see fit. And because they don't need capital rushing out the door, similar to like a bank run. If everybody starts pulling their money out, then you have these bank runs of sorts. So how this is going to play out is basically we see KingSett said, hey, listen, Thin Developments, they owe us over $300 million. And as that makes headlines, again, I think that they're forced to gate. This comes on the heels of 4, 5, 6 months ago. We had Romspin, which was another large, well-known Canadian real estate fund, which also had to close the gates. So you're having this cascading effect. And so again, remember I just walked you through the whole process that home building takes time, it's lengthy, it's drawn out. You got 20 plus year lows in pre-construction sales. Now you've got lenders which are basically trying to preserve their capital. They're having to close the gates on their investors and keep money into the fund. Capital is getting tighter and tighter in the development space, which comes to the conclusion of, is it going to be easier or harder in the near future to build new housing? And it's only getting harder. And this is why I say these governments with their housing targets, we're going to build 3.9 million homes by 2030 or whatever it is, are completely insane. I wrote a Substack newsletter, and I'll put a link to that in the description below if you want to go check out our weekly Substack, which we write to over 8,000 industry professionals every single week, is we wrote that these housing starts are going to continue to fall off of a cliff for these very reasons that are playing out. Not only are pre-sale weeks, but more and more developers are going bust. In fact, what we can see here is receivership growth in Canada. It's going to hit the highest levels in 10 years. This is data going back to 2014, and I would argue it's even higher. I think we actually didn't really have great data before that. So real estate insolvencies in the development space are growing at these levels, and it's going to get harder and harder to not only source capital, to get outside money in, for these projects to get built. So housing starts, the government is trying to basically funnel out housing accelerator dollars out the door, and they're trying to defy economic gravity. There is nothing that is going to stop this economic process from playing out, which is more developers will go bust, more developers will go insolvent. Bad money is going to be cleansed through this cycle. They're going to learn a difficult lesson. Housing starts are going to fall off a cliff. You're going to see rising layoffs in the construction sector until you can eventually start new again. And one of the ways you look to start new is you have to see a significant uptick in the resale market, which will then flow through eventually into the new construction market. But we are a ways away from that. And so there's more pain to come in that sector. So I have to laugh again when the government puts out these housing targets and housing accelerator dollars, and it's all talk. There's nothing they can do to stop economic gravity. In fact, I had to laugh because Christopher Freeland put out a tweet the other day saying, we're doing this, we're cutting GST on housing, and we're looking into banning corporate ownership of single family houses. First and foremost, corporate ownership of single family houses, the way it's construed, the way the average person thinks about it, is thinking, these massive REITs are coming in and buying all these swaths of single family houses. Guys, this is not middle America. This is not Southwest America, where these massive Wall Street REITs are going out and buying single family houses for $350,000 and buying massive communities. The math in Vancouver and Toronto for REITs doesn't work. These guys aren't buying single family houses for the long run. Why? Because what are you going to do in Vancouver? You're going to buy a house in East Vancouver, a tear down house for $2.2 million and rent it out for $5,000 a month? I mean, the math simply doesn't work. Where you're seeing some of these corporates buying single family dwellings is developers that are going and buying 5 houses in a row, sitting on it for 2 years, renting it out before they can get through the rezoning process. And the ability to pre-sell that project, which, as we just talked about, takes in many cases 4 or 5 years to get through. So that's where you're seeing corporate ownership in single family dwellings in these 2 large major metros. And so I have to laugh. If Christopher Freeland wants to hit her 4 million housing target, she's going to need a hell of a lot more corporate dollars into the housing market in order to get single families converted into multifamily buildings. So she should actually be encouraging corporate ownership. I get it. So I think it's important to understand when we talk about corporate ownership, the irony of that is you actually need more corporate dollars. Again, who builds housing in any of these cities? If you actually want it built, you need investor money from the outside. You need developers to go out there and deploy their own capital. So you need a whole pool of capital coming into the country. And this is where I start to worry about, we get on this longer tangent, but we can start talking about the regulatory burden in Canada, the investment landscape in this country, where people are no longer interested in starting new business and deploying capital even for real estate in this country because the prospects are so bleak today. So this is really the state. This is the state of the investment world in the real estate space. It's the state of the development space. And again, I think that we're going to be relatively well supplied in the housing space for over the next 1 to 3 years. We have a record number of houses that are still in the construction pipeline, that are under construction. We should see record completions, but those numbers are going to drop off significantly. And I talked about in my Substack a report that was done by the Parliamentary Budget Officer, the PBO, which they said, okay, we took the Fed's new updated immigration numbers, which suggest population growth is going to go to 0 over the next 2 years. What does that do to the housing supply balance or imbalance by 2030? And they said, well, yeah, it's going to shrink it, but we're still going to be short about 600,000 homes by 2030. And while, again, I had to laugh because, okay, well, how do they get to the 600,000 number? Because, these models are never perfect because they have to make assumptions. And the assumption was they're going to have annual housing completions running at 280,000. 280,000, we've thought, but yet the record high was 250,000 set back in the 1970s. So these guys think you're going to have record home building in a state where I just told you large developers are going bust. Receivership numbers for developers going insolvent are at the highest levels we've seen in a decade. Pre-construction sales are running at 20 to 30-year lows. I mean, how do you get to 280,000? So these assumptions, again, I think at many levels are going to be wrong. We'll continue to watch it as it plays out. Now, the one thing I'll say, most people say, man, this video so doom and gloom, so down. Well, we do have some good news. Starting this week, you're now watching this video on Saturday. We have an update that the OSFI stress test for people renewing and wanting to switch their mortgages is now gone. So let's give you an example. If you're at TD Bank and you just went through your 5-year term, on your mortgage expired, you want to leave TD and go to RBC Bank because RBC is offering you a new rate. TD is offering you 4.6, RBC is giving you 4.3, and you want to leave. If you want to leave and switch lenders, you no longer need to be stress tested. So you have some flexibility if you're kind of living on the edge and you want to switch lenders because you're being offered a lower rate. You now have that ability to actually go and shop around. So for those of you that have rate renewals coming up, I would highly encourage you to reach out to a mortgage broker, mortgage professional to go get some quotes and to go save yourself some money. As we know, there's still a huge cohort of people that are going to be renewing over the next couple of years, and they're going to see even today, you're going to see about 40%, a 40% payment shock, a 40% payment increase for mortgages that were taken out during the lows of the pandemic and renewing in 2025 and 2026, given where rates are today. So Keep that in mind as we press forward. We'll continue to update you through these videos on a weekly basis. Appreciate the ongoing support. We always hope that these provide value. If you have questions, comments, put them in the comments below. Feel free to email me directly. I do my best to get back to everybody, and we'll see you next week.